Joining me now with more is Ethan Powell. He's a principal and chief investment officer at Brookmont Capital Management. His firm is debuting this ETF. Ethan, welcome.
Thank you. Excited to be here.
Yeah, we're happy to have you. Tell our viewers more about what this ETF entails.
Well, it's the first access product to a fascinating asset class. The asset class is catastrophic bonds, as you mentioned. You know, maybe a scary name,
yes.
But really in today's climate of uncertain macroeconomic tariffs, uncertain rate volatility, right, that are impacting really every financial asset. Catastrophic bonds are actually tied to weather events, so totally uncorrelated to other risk assets. And effectively what they are insurers, reinsurers, and in some cases governments issuing these bonds. The cash that is raised sits in a collateral account, so there's no counterparty risk, there's no credit risk. There is the risk of a series of catastrophic events occurring that might impair the bond itself, but it's really a misnomer to say catastrophic events. It's a series, right? So if you think about the LA wildfires, 20+ billion of insured damages, the catastrophic bond market was only impacted by a little over 200 million, which represents less than 0.5% of the outstanding notional value. So it's not as scary as the name might imply, provides tremendous uncorrelated returns and low teens floating rate yield. So it's a great time to be investing in non-correlated assets.
Let's talk more about that, the timing of this. Why is this a fund that your firm wanted to launch now?
Well, if you think about where ETFs have come in the last 15, 20 years, right? They used to be low-cost beta vehicles. Today, more than half of the ETFs launched are actively managed. This is an actively managed fund. We're collaborating with Kingridge Capital, which are a group of highly competent professionals, PhDs in meteorology, climate risk, decades of experience underwriting these bonds. And so ETFs used to be a different fund wrapper, really for low-cost beta. At the same time, the catastrophic bond market was only $10 billion, right? Today it sits at over $50 billion, which compares favorably to a lot of municipal bond ETFs. And the bid-ask spread is 50 basis points, which compares favorably to a lot of other structured note fixed income instruments. So the asset class has matured, the ETF fund wrapper has matured, and we just happen to be in a period of massive uncertainty where this non-correlated return can really help risk-adjusted returns in a portfolio.
So let's talk more about its place in a portfolio, right? How would a viewer consider adding this in terms of maybe a portion of their overall portfolio? How would they know if it's right for them? Well,
look, I mean, anytime you want to go up on the efficient frontier, right, that's a positive thing. And basically in all cases in any portfolio, I'm sure my compliance people don't want me saying this, but it's empirically true. This asset class will help your risk-adjusted return. And it goes back to a correlation of 0.2 relative to basically any other asset class. So the alternative nature, and that alternative nature is intrinsic in the asset class itself. It's not like some of these buffered products that have been getting a bad name during this market downturn. And then alternative income, right? It's very difficult to find a floating rate yield that's in the low teens, and that's what this asset class provides.
Now, I'm curious in terms of how the holdings will change. You alluded to this earlier, and we know, our viewers know, that ETFs are dynamic. The holdings will change throughout its particular lifestyle. What can our viewers anticipate when it comes to what this particular ETF will entail over time?
It's a great question. So this is primarily an access product, right? So we are working with Kingridge Capital to manage liquidity, to make sure that we are sufficiently liquid to meet creation redemptions within the ETF. And then most importantly, diversification, right? Because yes, adding a portfolio of cat bonds will diversify your portfolio, but if they're all Florida hurricane bonds, now you're concentrated in a particular peril or geography. And that's what we're looking to diversify against, so that a California wildfire has very little, if anything, to do with a Florida hurricane.
Yeah.
So small position sizing, appropriate amount of diversification on peril, geography, trigger type, sponsor. There's a lot of factors that we're looking at, but that's really what we're managing over the course of time.
I see. It's April 1st.
Yes.
But no jokes with
No
this particular
jokes.
question. In launching this fund today, do you anticipate that catastrophes will increase?
So
Is that part of the thesis?
yes, part of the thesis. And another part of the thesis is, in order for this asset class to effectively fill its role in society, we need greater transparency and we need greater scalability. And that's what we're looking to accomplish with this ETF. I mean, you saw it with the LA wildfires, you see it in Florida.
Yeah.
People are underinsured, and this product is designed to appropriately price and disseminate risk into capital markets, expanding capacity for insurers, reinsurers, and municipalities, hopefully creating more resilient societies in those high peril areas.
Ethan Powell, he's a principal and chief investment officer at Brookmont Capital Management. Ethan, thanks so much for joining.
Thank you.
Yeah, we appreciate it.